Okay, so something huge just happened in the world of real estate. For the first time ever, Ethiopia has basically thrown open its doors to foreign property investors. We're talking about a country with a massive housing shortage and a population that's just exploding. And now, they're inviting you in. So yeah, we have to dive into this, because this isn't some tiny tweak to the rules. This is a potential gold rush.
So just how big of a deal are we talking about here? Well, the Ethiopian government's own estimate is that this move could unlock over $1 billion in foreign investment. And that's not a one-time thing, that's annually. This is a massive, fundamental shift for one of Africa's fastest-growing economies. The stakes? They couldn't be higher.
All right, so here's how we're going to break this all down. We'll start with the new rules of the game, then we'll build a real-world investment case study, a $500,000 bet. We'll crunch the numbers to see the payoff, pit Addis against other big cities, and then we'll get real about the risks before we give our final verdict. Let's get into it.
Okay, so first things first. What actually happened? What changed to make this whole conversation even possible? Well, it all boils down to one single landmark piece of legislation.
And here it is, Proclamation 1357. Before this law, foreign ownership was, let's just say, really complicated and restricted. This proclamation didn't just tweak the rules, it blew them wide open. It literally created a brand new asset class for international investors who are always on the hunt for that next big thing. So, if you're an investor, what are the new rules of the game? Well, you've got to bring at least $150,000 to the table. For that, you can own up to 5 residential units. And let's be clear, the whole point here is to attract that sweet foreign direct investment into a market that's already set to grow by 10% a year. The government has basically rolled out the red carpet.
Okay, theory is one thing, but let's make this real. Let's make it tangible. We're going to build a hypothetical but totally realistic $500,000 portfolio using current market data. This will show us what putting your money here actually looks like.
So, for our portfolio, we've picked out 3 apartments in some of the most prime, high-demand neighborhoods. We're talking Buli, Kazanchis, and Mexico. Now, why these spots? Because these are exactly the kinds of places that attract expats and the diaspora, and that's your key rental market. Our total investment comes out to $500,000, so we're well over that minimum threshold.
All right, now for the $1 million question, or in this case, the $500,000 question. How does this bet actually perform over 10 years? This is where the rubber meets the road. Let's crunch these numbers.
Okay, take a look at this table. Now, the first thing I want you to look at is that cash flow column. Notice something? It's negative the entire time. That means month to month, you're actually putting money in, not taking it out. But now look all the way to the right. The value of the portfolio? It's projected to double to $1 million. So what does this tell us? This isn't an income play. You're not buying this to pay your monthly bills. This is a bet on appreciation. It's a long-term wealth play, pure and simple.
So these numbers are great, but they can be a lot to take in. To really get what's going on, let's just boil it all down to the 2 metrics that every single serious real estate investor lives and dies by.
First up, we've got the IRR, or internal rate of return. Just think of it as the investment's true annual growth rate. Our portfolio, it's hitting 14.2%. Now, to put that in perspective, most global investors are thrilled if they can get 12%. So yeah, this number is strong. It's basically shouting, this is a very profitable long-term bet.
But, and this is a big but, here's the other side of that coin. The DSCR, or debt service coverage ratio, is 0.64. What you want to see is a number over 1.25. So what does 0.64 mean? In plain English, it means your rent money isn't going to cover your mortgage, not even close. And this right here is the core risk of this whole thing. You have to be ready, willing, and able to pay out of your own pocket for years while you wait for that property value to climb.
Okay, so we've got a classic high-risk, high-reward situation. But how does Addis Ababa actually stack up on the world stage? Let's zoom out and put it in the ring with some of its regional and global competitors. Just look at this. We're comparing it to Nairobi. The price-to-income ratio in Addis is a jaw-dropping 56. 56. That means it would take the average person living there 56 years of their entire salary, not just what's left over, to buy a home. It is one of the least affordable places in all of Africa. Now, that's a huge flashing red light for the local market, right? But it also tells you exactly why investors are laser-focused on renting to high-earning foreigners and diaspora.
And this right here is the reason investors are still so interested, even with that crazy affordability crisis. The rent. Addis commands way higher rents than its neighbors like Nairobi and Dar es Salaam. And it's that high rental income that fuels the whole engine, the potential for those strong yields and that long-term appreciation we were just talking about.
Okay, now for a totally different comparison. Let's put Addis up against a mature, stable market like Dubai. The difference is just night and day. In Addis, you're looking at rental yields that are almost double what you'd get in Dubai. So here's the trade-off, right? Addis is a high-yield, emerging market. Dubai is stable and premium. You're basically trading safety for a shot at some seriously explosive growth.
But that high yield, it definitely comes at a price. And we wouldn't be doing our job if we didn't look at the very real risks involved. You absolutely have to go into a market like this with your eyes wide open.
I think this quote from the source material just says it all, doesn't it? High rewards, but high volatility. That's the entire story in one sentence. You've got this incredible potential for profit smashed right up against some extreme market challenges.
So if we drill down, what are the big 3 threats you need to worry about? First, economic instability. We're talking high inflation and a currency that can lose value. Second, a potential market bubble, especially at that high-end luxury level. And third, there's always the political and regulatory uncertainty that comes with the territory.
But, smart investors don't just see a list of risks and run away. They see challenges that need a strategy. So what's the playbook here? First, you hedge your currency risk. Second, you avoid that frothy luxury bubble and focus on the mid-range where there's real demand. Third, you partner with local experts who actually know what's going on. And maybe most important of all, you play the long game. You have to be ready to hold for 7 to 10 years to ride out all that volatility.
So, we've laid out the incredible potential. We've looked at the very serious risks. After weighing all of that, what's the final verdict? What's the takeaway from this analysis?
Believe it or not, the conclusion from the source material is surprisingly clear. It's a buy signal. But, and this is a huge but, it's a buy only for investors who can stomach the risk. This is for people who have the appetite for that kind of volatility in exchange for that high potential return. This is absolutely not for the faint of heart.
So let's wrap it all up. The pros? An incredible potential IRR of 14.2%, driven by high rents and appreciation. The con? Significant risk, economic volatility, and having to cover cash flow losses for years. So what's the strategy? It's a long-term play. You build a diversified portfolio and you target that specific niche, the expat and diaspora rental market.
And all of this leaves us with one big final question. As we see more and more African nations opening up their economies, is this Addis Ababa model the future? Is this high-risk, high-reward game a glimpse of what's to come for investment across the continent? Or is it a cautionary tale in the making?